Hello, and welcome to OJM Group's webinar on premium financing. My name is Jason Odell. I am one of the principals at OJM Group, and today we'll be talking about premium financing, the uses of premium financing with estate planning and wealth accumulation life insurance products. Before we get started, there are a number of disclaimers that are on the screen in front of you. The important point to take out of these disclaimers is that those that you work with in any profession should be properly licensed and registered and have an expertise in the particular area in which you need help or are seeking advice. OJM has a number of different materials that are free to our attendees. These materials are shown on your screen here. We have a number of books for specific specialties as well as specific states. We also have a number of books that are there for physicians that can be used universally with physicians in every state and every specialty. At the end of this presentation, I will provide you with the access code so that you can download one of these books for free and or order one of these books from us in a hard copy format. Let's get started on our discussion today. What is premium financing? In its simplest form, premium financing is borrowing money from a lender or institution or individual to pay a premium on a life insurance policy instead of paying that premium on your own. Premium financing is useful or should be considered as an option when you are looking at buying life insurance and you meet a certain criteria. That certain criteria is an individual or individuals that have a net worth of $5 million or greater. They need life insurance for a specific purpose of death benefit and estate planning or accumulation purposes. They can get favorable insurance ratings from an insurance company because they're insurable. The individual or individuals have adequate cash flow for paying the interest payment, and they have adequate assets to be used for collateral, because if you're borrowing money from a lender, that lender will require that there is some form of collateral above and beyond the cash value in the policy and the death benefit in the event of a premature death. Visually, what does this look like? Premium financing with a bank up on the left-hand side of the screen. You can see that the bank provides financing to an individual or individuals. Those individuals then pay an interest payment back to the lender. So what you end up having is the bank over here giving or loaning money to an individual and the individual paying the interest on it. The bank makes sure that the premiums go to the life insurance company. The life insurance company provides a life insurance policy insuring the life of the client, and there's death benefit and cash value net of the loan. At some point in the future, whether that be at a premature death or at a timed event, the client takes a distribution from the life insurance cash value or death benefit to pay the lender off. And therefore, they end up with a policy that's free and clear of any lender obligation. And they have that policy that they can use for the cash value buildup for distributions or for the death benefit for estate planning and estate taxes. So, who loans the money? This is an important thing to understand, is there are many options out there for purchase or borrowing funds from an institution, whether that's a bank, whether it's your own bank, a bank that specializes only in premium financing, whether it's a group of investors who are loaning this type of money, whether you're borrowing this money from some type of trust or foundation or organization that you are aware of. And there are many options that allow for borrowing of $1 million plus every year. Lots of different places to get access to capital today at very favorable rates. Typically, what is the interest rate? In a annual renewable loan, typically you're going to have LIBOR plus some percentage. Typically that percentage is 1.35%. However, it varies from every single lender. That rate will reset every year based on where LIBOR is at that time plus some percentage. There are fixed rates available where you can lock into a fixed rate for a period of time. Again, rate structures vary significantly between financial institutions and or individuals. What strategies are useful to consider when premium financing is an option? Well, there's a couple that we're going to talk about today, but we break it down into three categories. One strategy that premium financing can be useful in is if an individual wants to put a significant amount of money into a life insurance policy to have a death benefit there in the event of a premature death, but then to also take a withdrawal or loan from the life insurance policy at some point in the future during their retirement years. Another option is to use premium financing strategy when purchasing significant sums of death benefit to pay estate taxes or to increase the size of one's estate at their death. Also, maximizing charitable gifts, premium financing is a great tool to use at that time as well. We're going to focus on using cash value life insurance in retirement. In an example here, we're going to show if an individual were to borrow $1 million a year, $1 million in year one, and then $500,000 in years 2 through 6. So a total of $3.5 million they would borrow from a lender. We assume that they could lock into a fixed interest rate of 3.5%. The client will pay interest payments annually to the lender as the money is borrowed, and they're going to repay back the $3.5 million in the 16th year. This was a 48-year-old male who was able to get preferred ratings from the insurance company, and we are going to assume their cash value was to grow at a 6.5% rate of return. The initial death benefit was $18 million. And this particular client was going to take distributions from the policy at their age 65 for a 20-year period of time. If these assumptions were to hold true, the client would take a distribution of $245,000, a little over $245,000 for a 20-year period of time. So in summary, if the client were to pay a 3.5% interest rate on the borrowed funds for a 16-year period of time, they would pay $1.6 million in interest payments. They would take $245,000 in distributions, totaling $4.9 million. The arbitrage between the distributions they get out of the insurance policy and the interest that they paid is $3.2 million. This client also needed to provide the lender with $440,000 of collateral that would need to be available in the early years until the cash value reached a point where it could cover 100% of the collateral needed from the lender. So in this example, this is a $3.2 million arbitrage that is able to be achieved based on these set of assumptions. This is just this is pictures showing exactly how the transaction were to work. The bank loaning $3.5 million, the client paying interest for 16 years. The bank is removed from this equation in the 16th year by withdrawing cash value of $3.5 million from the policy, paying the bank back. And this individual then took distributions for a 20-year period of time, starting in the 18th year, and for 20 years thereafter, getting $4.9 million. Another way to look at it is in a spreadsheet. This spreadsheet compares taking the insurance premium, or borrowing the insurance premium in column 1, putting it in the insurance policy, or fixing the interest rate at 3.5% and paying interest payments over the 16-year period of time, and then repaying the lender back in the 17th year. So if that were to happen, you can see in column 1 here that the $3.5 million is paid back in the 17th year, and the client is starting to take a distribution in column 5 of $245,000 through the 37th year or for a 20-year period of time. Alternatively, they could take the interest payment that they're paying in column 4, and instead of paying interest, they invested that money. Columns 11 through 16 show that that money is being invested instead of paying the interest payment. So they do not do the transaction. They just take the money and say, I'm going to put the interest payment that I would have done if I used premium financing and life insurance, I'm going to put it in an investment account. And I'm going to assume I can earn 6.5%. And I'm assume that I'm going to pay a 28.8% tax bracket. Does not mean that this client pays these clients could pay a higher tax rate, a lower tax rate. This is purely for example purposes only. In this instance, in column 15, they could start taking distributions in the 18th year of $245,000, but they run out of money in the 31st year. So they're able to withdraw from that investment $3.2 million at the end of column 15, as compared to $4.9 million in the life insurance policy. That's a $1.7 million difference, a significant difference for the same outlay of cash. As I mentioned, we've talked about two tools. One is estate planning, use of premium financing in estate planning. When you have a large estate and it is above the exemption amount, currently at a little under $11 million today, your estate will owe estate taxes that are significant, typically about 40% on the amount above $11 million today, and that amount increases. In this example, we had a 72-year-old client and a 68-year-old spouse. They were in great health, and they needed to purchase a significant amount of life insurance. They needed $15.2 million of life insurance. We were able to get $25 million of death benefit. And the premium, they have two options: pay the premium on their own or borrow the premium from a lender. In this example, they looked at both options. One is if they were to finance it and borrow $907,000 a year for 6 years and put that into the life insurance policy and have a 3.5% interest rate, that would be paid back to the lender. They would pay $3.3 million in interest payments over a 20-year period of time. We have their life expectancy at 20 years, so at 92 and 88, that's what we used as life expectancy. If they chose to just pay the premium on their own, they're going to be paying premiums in excess of $240,000 a year for a 20-year period of time, or $5.9 million. So in this example, if they don't finance it, they're going to pay $5.9 million over 20 years to the insurance company, or they could pay interest payments to the lender of $3.3 million. That's a difference or an arbitrage of $2.5 million. Represented here in this spreadsheet, where you have the premium being borrowed in column 1 of $907,000, as compared to column 8, where you don't finance it and you just pay the premium, which is $295,000 a year for 20 years. Again, you end up with the same death benefit amount of $15.2 million, but you're doing it based on these set of assumptions in a more economical way. We also then compare if you pay interest versus the insurance premium payment. You took the difference between that and you invested it in an investment account that earned 5%, and you pay taxes again of 28.8%, purely an assumption, can change and will change with every client. You would actually have an additional $4 million of savings invested by doing the premium financing option as compared to paying the insurance premium outright on your own. Once again, we illustrate this in a picture format where the lender's providing the money, the client is borrowing and paying the interest, the death benefit is there to pay estate taxes and replace any of the estate that's lost due to estate taxes at the death of the client. This is a great option to at least consider when you're buying large sums of death benefit, or in fact, any amount of death benefit. Premium finance should be considered as an option, or at least use the example to build a spreadsheet to determine does it make sense based on a set of assumptions. Not only that, but after 20 years, there's a $4 million excess that's sitting there that can be used for whatever the individual wants. However, there are many things that one should consider when considering premium financing. First is your time frame. How long do you have? Do you have enough collateral? What is your ability to exit the situation? What were the assumptions that were used to calculate everything? Reviewing and analyzing it every single year is extremely important. You want to have flexibility in the design of this particular tool. This tool is certainly not for everybody. It is for a specific set of criteria that one would meet in order for this to become an option. It needs a lot of analysis and explanation done. It's something OJM has a specialization in and can help clients understand this particular tool. OJM works with clients in a number of different ways. Premium financing is one particular strategy and or tool that is in our tool bag. These are a number of other different areas that we can help clients with in their overall planning. OJM has a unique wealth management strategy and firm. We have multiple specialties that work in our firm, from CPAs to attorneys to financial planning professionals to investment experts and insurance experts, all on our team that are here to assist our clients. We work with clients in 48 states. We help them with their personal and or corporate or practice planning. We've been doing this since 1992. It is an area that we have a lot of expertise in. As I mentioned before at the beginning, you can download one of our books by going to our online bookstore at ojmbookstore.com and using the promotional code WEB0816 at the bottom right of the screen. In addition, we'd be happy to schedule a free consultation, no obligation, with you that can be done. In doing that, we would learn a little bit more about your particular situation, what's important and what are your goals, explain a little more about OJM and how we can be a resource to you and or help you. Thank you for listening. Have a good day.